Given this apparent disconnect that we're seeing between relatively strong data in countries like Germany, where we saw the CPI strengthening yesterday, jobless rate coming down, you've seen pretty strong PMI data out of China today, the US unemployment rate is relatively low. Given that context and then the geopolitics that we're seeing in Europe, how does that feed into your view on equities?
Well, overall at the global level, we're neutral equities, we're underweight credit, and we're overweight cash. And I think if you look at the economic data as it comes in, though it's reasonable, the overall economic surprise index at the global level is negative. In fact, it's at the most negative we've seen since Q1 of 16. So the overall situation is that somewhat overly bullish consensus views on the global economy are being challenged. Now, we don't think that resolves itself in a global recession, but it does fit with what we're seeing in our earnings modelling, where we also think that consensus earnings estimates going into the year were too high. And valuations were also very high at the start of the year. So that's, in essence, why we're neutral on equities.
On China, you're more positive on the A shares, and you think there's some opportunities, some trends, and you're already seeing those in terms of the A shares. And of course, we've got the MSCI inclusion that's happening this week.
Yes.
Talk us through what the opportunities are in that space.
So if you look at the offshore China universe, the MSCI China, it actually hit our target price earlier in the year, and we've actually taken that down slightly since then. But if you look at A shares, there's still a sort of mid-single-digit upside to target price. They're unusually cheap versus the offshore indices. They're at about sort of 13 times forward on our earnings numbers, so considerably cheaper than they typically are to global equities. They do offer diversification benefits. They're less correlated with global equities than other markets because they haven't been in the indices until now. And then the index inclusion event itself causes some inflows. And we've seen that in the last few months already.
And you expect those inflows to gradually tick up?
Yeah, so the index weight by the end of the year is going to be about 1% of the MSCI EM index. We're recommending a 5% weight, so a substantial overweight in A shares, in the sense that on a pro forma basis, as we actually get the inclusion factor rising, as China further liberalizes exchange controls, that will take place. We think that investor flows will continue to build towards A shares, and eventually the A share component will be as large as the current offshore China component within global indices. And
the A shares of the CSI 300, you've got a view that that's going to tick up by the end of 2019 by about 7-8%?
Yeah, so 4,200 is our target price, and so relatively cheap and probably slightly better earnings growth given the sector skew and the stock skew than actually you're going to get for the offshore China universe. So ballpark 9 to 10% CAGR for EPS and renminbi this year and next.
Is the added focus, given that inclusion into the MSCI Emerging Markets Index, the researchers bulking up their teams here, looking at those 234 additional stocks, that price discovery, is that also a positive?
Yeah, so what's interesting about the A-share market, and I've covered it for a number of years from the offshore perspective, is that if you look at it, see, even 3 years ago, heavily retail investor driven, sort of momentum style was somewhat dominant. But actually institutional asset development has taken place here. We've got more mutual funds, more pension funds. And so factors like price to book, price earnings, profitability, they're starting to actually determine stock returns in A shares much more than before. So it makes it much more investable for offshore institutions when they know that those factors will actually work in driving stock returns.
And obviously a big cloud over what we're seeing in China more broadly are the tensions between Beijing and Washington when it comes to trade. Is that a case of cutting through the noise and zeroing in on the stocks and the sectors that will be relatively sheltered from that dispute? How do you balance that out with the opportunities?
So if you actually look at listed equities in China, they have relatively low direct revenue sensitivity to the US. In fact, lower than other export-oriented markets in Asia, so like Japan or Korea. Where you are seeing an effect is in terms of imported inputs and sort of component sensitivities at the stock level and at the sector level. Broadly speaking, this whole debate about protectionism is more negative for autos and tech than other industries. And on the domestic demand side, it's less of a factor. So
for the moment, you might steer clear of autos and tech?
Well, we're actually cautious on those for other reasons, actually. End-use demand growth globally and indeed in China for things like mobile phone, smartphone handsets and for autos is going to be quite soft the next 2 years. And what is actually stronger in terms of our forecast, both globally and within China, is actually CapEx, particularly private CapEx-related sectors we're interested in. Yeah.
Are 8 shares still overvalued in your view?
Well, again, 8 shares very close to our target price, so essentially their target is pretty well flat on where the index is trading right now. They have cheapened up compared to where they were at the start of the year, but in terms of the earnings outlook, it's reasonably constructive for the financials and energy part of 8 shares, but they're on a more expensive multiple to their own history than the CSI 300 is right now, so hence the preference for A.
And in terms of emerging markets, you're constructive on Thailand, Singapore, for example. You're overweight, is that correct, on Thailand, Singapore? What's behind that? What's driving that? Is that an energy play?
So we made a lot of changes in our recommendations late last year. We wanted to play defence more, or we wanted to look more for the value factor. So if you look at, say, high trailing dividend yield, low trailing PE, those markets do quite well. They also are not very caught up in the trade protectionism debate. They don't have revenue sensitivity, and they don't have high weightings in IT and autos. They do have high weightings in domestic sectors. And then on the energy side, Thailand is an energy importer, an oil importer, but Singapore actually makes a lot of money out of oil refining and building of oil rigs, for example. So to some extent, a higher oil price is actually quite good news for Singapore. Those two markets are amongst the best performing in the world year to date, so that kind of playing defence strategy is something that has worked out.
A quick one on the Fed and the risks of a taper tantrum. Is that now in the past?
Well, we're seeing a lot of volatility in, let's say, the parts of EM on the sovereign side that are running current account deficits and have relatively high inflation. So that's a clear rerun of the summer 2013 that is ongoing. And then we have what's going on in Europe that I'm not an expert on, but the widening of peripheral spreads. So, the Fed is partly what's driving this, but also there's the issue that some of these imbalances were not solved for in some of the countries over the last 3 or 4 years. Some countries did fix the situation. Thailand, for example, has gone to running a major current account surplus, whereas it was running a deficit in the taper tantrum era, but not all of the countries have managed to do that.